Ladies and gentlemen, good day, and welcome to the Q1 FY26 earnings conference call of Concord Biotech Limited, hosted by Centrum Broking. Please kindly note that this conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements do not guarantee the future performance of the company, and it may involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your dashboard phone. Please note that this conference is being recorded. I would now hand the conference over to Mr. Sumit Gupta from Centrum Broking. Thank you, and over to you, sir.
Hi. Thank you. Good evening, everyone. On behalf of Centrum Broking, I welcome you all on the Q1 FY26 earnings conference call of Concord Biotech Limited. Today from the company, we have with us Mr. Sudhir Vaid, Chairman and Managing Director, Mr. Ankur Vaid, Joint MD and CEO, Mr. Lalit Sethi, CFO, and Mr. Prakash Sajnani, AVP Accounts and Finance. I would now like to invite Mr. Sudhir Vaid, Chairman and MD for Concord Biotech, to give his opening remarks. Over to you, sir.
Good evening, everyone, and thank you for joining us on our Q1 FY26 earnings conference call. We reported a stable performance this quarter, with revenues at rupees 204 crores, impacted mainly by revenue lumpiness. The preceding quarter had exceptionally high sales, and historically, such strong quarters are followed by relatively softer ones. While this pattern persists, we remain confident on achieving our long-term goals. On the EBITDA front, the decline was primarily on account of commercialization costs of our new injectable facility in Valthera, which affected EBITDA and margins. We have a robust pipeline of products and have started taking validation batches of these products. Excluding the injectable facility cost, the EBITDA margins stood in line with the same quarter last year. Overall, Q1 FY26 reflects the successful execution of several key strategic initiatives. Notably, we received approvals from the US FDA to market teriflunomide tablets 7 mg and 14 mg for the treatment of relapsing forms of multiple sclerosis in the United States. This is an important addition to our portfolio and underscores our commitment to bringing high-quality therapies to global markets. Over the past few months, our facilities have successfully cleared inspections by the US FDA, EU GMP, and Russian GMP authorities, reaffirming the strength of our quality and stringent manufacturing standards. These approvals positions us to ensure uninterrupted supply to global markets without regulatory hurdles. We have further strengthened our presence in the US through the incorporation of Stellan Biotech Inc., which will focus on the marketing, distribution, and commercialization of Concord Biotech pharmaceutical and biotech products in the US market. Stellan will manage end-to-end commercial operations, and it may also collaborate with third-party partners for marketing their products in the US. This will not only establish a direct commercial footprint in the US, but also supports our broader objective of expanding market access and unlocking greater value from our product pipeline across key global markets. Additionally, we incorporated Concord Lifegen Limited as a wholly owned subsidiary to further strengthen our domestic marketing, sales, and distribution capabilities for pharmaceutical products. This move will allow us to establish a sharper market focus, enhance customer engagement, and create a stronger brand presence in India. Last quarter in March 25, we successfully commercialized operations at our new injectable facility situated at Valthera. This advanced plant has been meticulously designed and constructed in line with stringent international standards. It reinforces our commitment to delivering high-quality products consistently and further strengthens our manufacturing capabilities. Moving ahead, we will continue to pursue strategic investments as opportunities arise, while advancing our product pipeline and seamlessly driving our R&D initiatives. We remain focused on expanding our API, formulation, and CDMO business, delivering a high-quality products, maintaining global standards, and securing regulatory approvals. These efforts position us as well to capture growth opportunities effectively. We are confident that we are poised to accelerate our business growth. Thank you. With this, I hand over the call to Mr. Ankur Vaid, Joint Managing Director and CEO of Concord Biotech Limited. Thank you.
Thank you, sir. Good evening, ladies and gentlemen. We reported a moderate quarter with revenues down 5% to 204 crores. I would like to highlight that our business is best evaluated on a long-term or at least on an annualized basis rather than quarter-on-quarter. The lumpiness can stem from changes in customer procurement patterns or sales spillover into subsequent months due to approval timelines. This quarter was one such example of that lumpiness. However, our long-term growth strategy story remains intact. Notably, our EBITDA and PAT registered a decline primarily due to the commencement of our injectable facilities at Valthera. These initial costs are expected to weigh on EBITDA margins until revenue from the facility scales up, gradually through FY26. However, excluding these startup costs, our EBITDA margins stood at approximately 37% in line with the same quarter last year. Moving on to the segmental performance, in Q1 FY26, our API revenues stood at 153 crores, reflecting a 10% year-on-year decline. As I mentioned earlier, customer procurement patterns can be uneven, and this often leads to quarterly fluctuations. A full year view provides a far more accurate picture of the underlying performance of our API business. On the formulation side, revenue grew 12% year-on-year, reflecting healthy traction in the segment. During the quarter, we commenced operations at our injectable facility in Valthera. We expect this segment to start contributing to the revenues in FY26 with a full ramp-up anticipated over FY27 and FY28. On the regulatory front, we continue to enhance our compliance and preparedness across all facilities. We are pleased to report the successful completion of multiple key inspections at our API manufacturing facility in Dholka, Gujarat. During the period, our API facility in Dholka underwent an inspection by the US FDA, and we are pleased to report that we have received the EIR report from the US FDA for this inspection, further affirming our ongoing commitment to regulatory compliance and operational excellence. This facility was also successfully inspected by European GMP, conducted from July 14th to July 18th, 2025. Additionally, this facility passed the Russian GMP inspection held from July 22 to July 25, 2025. These achievements underscore our commitment of upholding the highest standards of quality, safety, and regulatory compliance across all aspects of our operation. It reflects our dedication to excellence and our continued focus on meeting the rigorous requirements of global regulatory authorities. Moving forward, our global expansion efforts continue to gain momentum. We have now filed over 138 DMFs and secured approvals for ANDAs across key international markets, further enhancing our product reach and customer base. From a strategic standpoint, incorporation of Stellon Biotech and Concord LifeGen will provide growth opportunities in US and India and further strengthen our position in these markets. We continue to focus on manufacturing niche and complex products with limited competition. Currently, we have a portfolio of 30 plus products with several more under development. Our strategy is to leverage our technical expertise to swiftly capture market opportunities and increase our market share. Concord remains one of the few companies globally producing more than 30 fermentation APIs across multiple therapeutic areas, including immunosuppressants, oncology, anti-infectives, and antibacterials. Supported by a robust R&D engine, we are consistently expanding our molecule portfolio to strengthen our long-term growth trajectory. In Q2 FY26, we marked a significant milestone in our diversification strategy by initiating sales to our CDMO business to the US market. We view the CDMO segment as a high growth opportunity for Concord Biotech, driven by increasing global demand for dependable, high quality manufacturing partners. Our team are actively collaborating with more innovators and largely generic pharmaceutical companies on projects ranging from early stage development to commercial scale supply. Encouragingly, we are receiving and responding to a growing number of RFQs, and we remain optimistic about the future prospects of this vertical. We currently have one commercialized CDMO project and have started our sales to them in Q2 FY26. We are also currently in advanced discussions with several potential clients to expand our CDMO engagement. Backed by our proven technical capabilities, strong compliance track record, and expertise in handling niche and complex products, we are well positioned to secure a meaningful share in this growing market. Over the medium term, we expect the CDMO business to become a significant contributor to our overall growth and to further strengthen our relationships with leading global pharmaceutical companies. With this, I hand over the call to Lalit Sethi, our Chief Financial Officer, for financial and operational performance. Thank you.
Thank you, sir, and good evening, everyone. Let me take you through the financial and operational performance for the quarter. On the revenue front, our revenue for Q1 FY26 stood at rupees 204 crores as compared to 216 crores in the same period last year, 5% lesser in this quarter. Revenue from the API business stood at 153.8 crores against 171.1 crore in Q1 of the last year, down by 10%. Revenue from the formulation business has grown by 12% in this quarter from rupees 44.8 crore to 50.2 crores. And revenue from the domestic and export businesses are lesser by 5% in Q1 of this financial year as compared to the same period last year. Speaking on EBITDA, EBITDA for this quarter stood at rupees 61 crores as compared to the 81 crores in the Q1 of the last year, and EBITDA margins for this quarter stood at 30.1% against 37.7% in the same period last year. As mentioned, the costs related to the commercialization of our new injectable facility have temporarily impacted EBITDA. However, as revenue from the facility scales up, we expect to benefit from operating leverage, which will enhance overall EBITDA and margins. Excluding this, our EBITDA for the quarter stood at approximately 37%, consistent with Q1 of the last year. On the profit after tax, our profit after tax for this quarter stood at rupees 44 crores as compared to the 60 crore in the same period last year. Our PAT margins for this quarter stood at 21.6%. So with this, I shall now leave the floor open for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the dashboard telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use headsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Yagnam Pathak from AM Securities. Please go ahead.
Hi, thanks for taking my question. So the cost impact you have seen related to the Volterra facility, so if you do some back calculated around 14 crore rupees. So firstly, is it a close by figure? And if you can please quantify how much of it would be personnel cost?
So, around 12 to 13 crores is the expense that is related to the injectable facility.
Okay. And any one-offs included in this?
Out of it, 4.27 crore is on account of the employment cost. Power and fuel is around 2.77 crores, and remaining is the other expenses.
All right. Thank you so much.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Maitri State from Choice Institutional Equities. Please go ahead.
Hi, thank you for the opportunity. I just have a couple of questions. One is on the export revenue. So just wanted to understand how much of it is coming from the US. And second is, given that we are still in line to achieve our EBITDA margin guidance, could you please throw some color on by which quarter can we expect these increased expenses to normalize? That's all.
So as far as the bifurcation of exports revenue is around 45% of the total revenue is exports and 55% is the domestic. Out of the export revenues, around 17% is to the US and 33% is to rest of the world.
Okay. That explains. Thank you so much. Secondly, on the EBITDA, if you could just give some idea.
EBITDA, as I mentioned it to you, this time it is impacted because of the commercialization of the injectable plants. In case excluding this commercialization, the startup cost, it will be in line with what it was in the same period last year. So it was 37% last year. So this year also it stood at 37%.
Okay. Thank you so much.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Vivek Agarwal from Citigroup. Please go ahead.
Hi, thanks for the question. Ankur, just as for the dip in this quarter in API business is concerned, so is it mainly driven by quarterly fluctuation in procurement, etc., or is there any impact of pricing headwinds as well, right? Because multiple companies, especially in the API space, are reporting some kind of headwinds as far as generic pricing is concerned. Thank you.
So this is primarily on account, as mentioned earlier, Vivek, it is on account of the lumpiness in the business that we have seen because of the heavy Q4. Because again, we are anticipating that the customers would be having some bit of inventory in their hands, because of which we have seen that lumpiness in Q1. So that is the reason because of which we have seen this.
Thanks. And how is the pickup that is happening in the new Limbasi facility and especially in the onco and the anti-infective segments, if you can throw some light?
So oncology is only being catered to Unit 1. We do not have oncology at the Limbasi facility, but the Limbasi facility is picking up quite well because most of the new products will be getting validated and commercialized from the new site only. So last year we did nystatin, so that was manufactured at Unit 3 only. We have a couple more products that we are looking at commercializing in this year, and those would also be coming from Unit 3 only. So, as we start building more molecules, as more molecules become commercial, and that will further help us kind of optimally utilize this Limbasi facility.
Thanks. And Ankur, just if you can throw some more light on the CDMO contract as well as the commercial supplies that you begin this particular quarter, right? So that will be helpful. So how much or what kind of the revenue ramp up that can be expected in, let's say, over the next couple of quarters, and what type of the product this is, and what are the customers, whether it is generic customer or the innovator customer. So that would be helpful. Thank you.
So they're a mid-sized innovator company who have recently launched the product. So it's a new product that they've launched, and we have catered to one of their orders. We have a couple more which are already there in the pipeline, so it would be executed also. It's picking up quite decently. However, we don't have the forecast from them because, as I said, that they've just launched the product, and we anticipate that some kind of a forecasting would be provided to us by next financial year. And this year is going to be more about getting the product onto the market and seeing that how the product moves. But so far the response from the market has been good.
So this is a product launched by an innovator company very recently.
Correct.
Okay, and it is there in the human health, right? Rather than any veterinary or ag chem, etc.
This is also in vet.
This is in vet. Okay. Thanks. I have more questions. We'll join back the queue.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Sumit Gupta from Centrum Broking. Please go ahead.
Hi. Can you, sir, let us know on new API molecules which we are working on currently?
So, currently we are working on mostly on the antibiotic segment and oncology segment. As I mentioned earlier, we have close to around 10 to 12 products which are there in the pipeline, and a couple of them are at relatively advanced stage. We are expecting around two to three molecules, a couple of them through antibiotics and maybe one molecule or so from the oncology.
Okay, so what can be the potential market size of this?
The potential market size for each product, I can come back to you with the exact numbers because again IMS doesn't provide at the API level. But I would say this would be put together both the three products. I would say close to around $500 to $700 million, and on both of these, on all of these three products, again, the same thing is there, wherein you have maybe 2 or 3 player market with limited competition coming in. So they are again both complex niche. Even though it is the antibiotic space, these are again complex niche molecules where around 2 or 3 players are there. Similar in case just like nystatin. If you see nystatin, which we launched last March, filed the DMF, it is also an antibiotic, but there are only 2 players, both of them from Europe. So, that gives us a lot of advantage with the kind of scale that we have, the expertise that we have, and the approvals in place. So, similar kind of thing we are seeing in these 2 or 3 molecules that we are looking to kind of launch in this year.
Understood, sir. And second question is on the injectable facility. So what kind of ramp-up can we see for this facility?
So as we have discussed previously also in other calls, that this year is going to be more about launching in the domestic markets only. So while filing for the emerging markets. So for this year, we've already taken validation batches for a couple of our products in the first quarter only. We have a couple more products that are lined up for validation in quarter 2 and quarter 3. So, we'll take our validation batches, we'll be catering to the India market and then be filing in the emerging markets. And somewhere by end of next financial year is when we will see commercialization of products in the emerging markets. So that is with respect to the ramp up when you see it from the emerging markets. But now that we are fully integrated on the injectable space, we see ample opportunities even in the domestic. So we are just seeing how things would move, and Concord LifeGen and all these are ways to kind of keep further penetrating into the Indian market more and more. So much of the groundwork is there in place now, so that we can kind of move more aggressively into the injectables market even in India. Because we have the API, the front end is already there, and now that we are manufacturing ourselves, we'll have a full integrated approach to cater to the markets.
Sure. Thank you. All the best.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Alankar Gardule from Kotak Institutional Equities. Please go ahead.
Hi, good afternoon, everyone. Sir, firstly, can you provide the capacity utilization across all the facilities?
Yes. In the unit 1, in this quarter, the capacity utilization is 75%. And for Valthera, it is around 26%. And for the Limbasi, it's around 57%.
Sorry, can you repeat the number for Limbasi again, sir?
Limbasi, it is 57%. For Valthera, it is 26%, and for Dholka, it is 75%.
Okay. Sir, 2 questions then as follow-ups. One is on Limbasi, we were at 40% in the fourth quarter, which is increased to 57. So, how should we read this, considering that API sales have declined even on a sequential basis?
Oh, last year we were at 50%, not 40%. It was 50%.
So you are saying fourth quarter FY25, the previous quarter, not last year, we were at 50%?
No, yes, we were at 50%. To be precise, it was 52.62%.
Okay. Fair enough. And the second question linked to this is, if you look at Valthera, there the utilization levels have dropped. Does this include the injectables capacity as well?
No.
So in that case, was there any impact of this lumpiness on the formulation sales as well in this quarter?
So lumpiness, I won't say is much there in the formulations, but it could be that certain material that has been manufactured and shipped by sea has not been considered into the sales. So like a cut-off sales could be because when we supply to LATAM and to the US, we use sea. So it could be some portion of that could be on account of that.
Understood. The second question was on pricing. Now you mentioned that this decline of 10% year-on-year is predominantly due to the uneven customer procurement patterns. But just on pricing, would you like to comment whether pricing has been stable on a YOY as well as on a QOQ basis? And broadly, given that we have offered price discounts to customers which have a higher volume offtake, is that something which continues for us, or have we seen any change as far as those patterns are concerned?
No, so when we are working with customers across different geographies, prices to many of our customers remains relatively same. However, when we are entering into newer accounts or we are entering into newer products, say for example nystatin or voclosporin, at those times for those opportunities, the prices could be different, because if say you are entering as a second source supplier into certain accounts, the price expectations, given that they are larger in volumes, could be different. So, it depends upon market to market, it depends upon customer to customer. But whenever you are entering as a second source, be it for your existing or newer products, there could be some pricing benefits that we have to give to the customers. Now that pricing could be above our average price or could be lower. But the impact of that, I would say, could be at times relatively lower, given that we have a much larger base. So the impact may not be that much significant enough. But that is something that, for future businesses with the newer opportunities, with newer products, new customers, something that we do on a case-to-case basis.
Got it, Ankur. Just one question here is, given that there are no new launches as far as immunosuppressant is concerned, would it be fair to say, given your comments, that pricing in immunosuppressant is more or less stable, and for the other therapeutic areas, as we expand our presence, there possibly pricing can move a bit depending on some of the new clients which we are targeting?
I wish, Alanka, I could say that prices will remain stable for years to come. But, as markets change, for now, things look stable. But I cannot say that how markets would do or how markets would behave. The only way to counter any of these kind of price impacts that may come is through your R&D development. So, we keep investing in our R&D for our existing products also, so that maybe if not today, tomorrow something comes up, we are able to kind of absorb any of the pressure that may come. So, that is the only way that we have to kind of work towards products which are a well catered to and well addressed market. And also, given that, as I mentioned earlier, that we have 30-40% of the world market share, we still have another 40-50% to target. So many of those opportunities we are already targeting in different geographies, for which we have already undergone regulatory inspections. We have done the filings in those markets, and we are awaiting approvals in those markets. Now that can happen in this year or in subsequent year. We have to see that. But whenever that opens up, that will also help us increase market share even in our existing products. So we know which are the customers that we need to target. All our efforts are towards that. And as a result, what I mentioned earlier, that if you're targeting those second source opportunities, then there the pricing could change because of that. But if it happens to our existing customers for different reasons, then the only way to address that would be through continuous R&D improvement.
Got it, Ankur. So basically, you are saying that even for immunosuppressant and other therapeutic areas as well, depending on the new customers we want to target, pricing can vary accordingly.
Correct. I'll tell you an example just to kind of, for one of our products, which we have recently launched, the market price was close to around $350-400. We launched it at almost 25% discount. And at that price, many of those European players are not able to compete. And that is the reason why we are seeing a lot of traction. But even with that price that we have, we are able to maintain healthy EBITDA margins. So while we are going as a second source opportunity. So you have cases like this also, and then you will have cases where we have to go maybe at certain products, certain cases below our average price. So, it's dynamic in nature is what I wanted to kind of put it across.
Understood. And one last question with your permission. So when you talk about losses from the injectables unit easing off over the course of the fiscal, how should we look at EBITDA margins for the full year? Because 30% this quarter clearly is much lower than what we have done for many number of years. So given this performance, how should we look at the EBITDA margins for the fiscal?
Yeah. So if you remember that in our last year, first quarter also, the sales were relatively subdued. And that time also we had mentioned that, it could be also as an impact of the fixed cost which is there and all. So, that injectables fixed cost is getting fully loaded on the base that we have for the first quarter. As our sales starts moving up, this percentage impact will go down. So while the value would be more or less in line with what it is, but it will trim down when you would start looking at it as the time horizon increases. It is just that for quarter one it looks higher because of the lower sales numbers.
Got it. Do you expect the facility to break even by the end of FY26?
I would hope so. I would want it to, but the only way for it to kind of do that is that we are putting a lot of our efforts on the domestic front, because the opportunity even in India market is significant for some of the products that we have taken the validation batches and some that we are expecting in the coming months. So those opportunities are large, and we are having a more focused approach to kind of penetrate on these 4 or 5 products that we are launching from India for the India market. But these things take time to kind of engage with the doctors, to engage with the hospitals. Let's see how that goes. But I think given the market size opportunity even in India, we are quite optimistic in terms of how things can move. But again, we have to see that how market behaves.
Understood. That's very helpful, Ankur. That's it from my side. Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Vamshi from Antique Stock Broking. Please go ahead.
Hi, am I audible?
Yes.
Thanks for the opportunity, sir. I just have a couple of questions. Firstly, on the CDMO front. So the new contract that we have entered into, is it on the API side of it or the FDF side of it? And in terms of the pricing, is it fair to assume that it's a cost plus margin kind of a strategy that we use?
So the opportunity is actually on both front, both API and formulation. So it's a more integrated kind of a play that we are working with them. And yes, it is a cost plus model.
All right. Secondly, in terms of the new, acquisition that we have done on the US front, so given that US already contributes 17% to the top line, before this did we have front-end presence there, or is it that we relied on someone else to do the distribution for our products?
So maybe I'll clarify that. So the 17% export that goes also has component of API as well as formulations. The direct formulations that we are selling into the US, Concord Biotech is basically going to be working in that front. When it comes to APIs into the US market, there we will continue with our existing channels, which is direct marketing through Concord to those customers in the US. This is only with respect to the formulation, because as our portfolio is increasing, is where we are seeing in terms of how we can do that in-house. So this is again primarily focused only towards formulations, both in-house as well as from third-party manufacturing.
Got it, sir. Just one last question. So, given our business has a lot of cyclicality, especially on the API side, how should we look at the overall growth for FY26? And if you can also give some color on how the API and the formulations segments could perform.
So I won't be able to comment in terms of giving any guidance in terms of how this year would look like. But, typically our business has growth coming from 3 or 4 areas. One is the market growth. Secondly, we have innovators business getting converted to generic, which also gives us a market share growth. Third is new customer acquisition. So, like a second source opportunity. So wherein we enter as a second source with the intent to become a primary source. And the fourth is the new products category in terms of how fast we kind of penetrate into customers and start, that churning into the volumes. So these four components kind of make the overall growth for us, which does not include the injectables, which does not include the CDMO. Now, in a particular year, there could be that the third and the fourth bucket are playing out very significantly out, and there could be certain years where it may not play out as much as we would have anticipated. So for me, it is difficult to say at this point that what that growth number could look like. It could be 20 plus, it could be a very different number. But I think, given where we are confident that, it should be in line with what our historical performances has been. But I just wanted to put it across that these are the four buckets with which play out in terms of the growth. And we've put all our efforts to kind of that each of these segments kind of plays out and contributes the way that we've looked at. But I expect it to be in line with what historically has been, without giving any kind of a guidance to it.
That is very helpful, sir. And just one last question with your permission. So in the injectables bucket, how many products do we have, and by when do you kind of target launches for this?
So we have already started selling. Yes, in the injectable formulation, we have already started selling in the India market. We have currently launched 2 products from the injectable facility. We have another 2 which are expected to be commercialized in the coming months. And we have around 10 products in our phase 1 that we intend to launch, for which the work is ongoing.
Okay,
and for most of these 10 products, we are backwardly integrated.
Got it, sir. Thank you. Yeah.
Thank you. The next question is from the line of Kishan Toshniwal from Polar Ventures LLP. Please go ahead.
Good evening. I have basically 2 questions. First is, we are into different segments, right? API formulations and right now into CDMO as well. Just wanted to know the profile of our margins. Is all the businesses are having similar kind of margins, or the businesses have different margins?
So in fermentation, as you see, there are very limited players globally. When we are competing with the likes of Southeast Asians or European players, definitely the margin profiling is very different, compared to the finished formulations, which is relatively a little bit more crowded, if I may say. So in short, the answer is yes, the margin profile is very different between the 2 different segments.
Okay. And the second question that I have, I'm seeing the R&D spend, that is a percentage of our sales. It was 3.6% in 22, 3.5 in 23, and it has dropped to 2.3%. Can we have a ballpark picture? What is the future that we see? Because as more and more R&D spend increases, our pipeline also increases. Is my understanding correct?
So, in fermentation, the R&D spend is different from the way that R&D spend happens in formulation. In formulation, much of the R&D spend is coming from the API, which we end up buying at a higher cost, as well as the BAB studies that we do. So that's why the spend in the R&D looks different than what our numbers are. In fermentation, what we do is that much of the R&D actually happens at a very, very small scale. And the best of the results are only the ones that we kind of take it to a larger scale. So this is more about the expertise rather than at the volume game. And that is why, the spend looks lower, but the output or the productivity plays out a lot more here. So, fermentation R&D has to be looked differently than some of the other formulation companies that they kind of work on. And in our case, we do not have any KSMs that we end up buying from China. Our KSMs are something which are locally sourced, which are agro-based products. So, the cost also becomes relatively lower. So it's more about the expertise rather than the cost.
Okay. And if I can squeeze in one more, the R&D employee strength that you are showing greater than 135, if I may know, these are all the, scientists only, or these are different category persons like scientists and their subordinates and all kinds of things?
So the 135 that is there includes everybody in the R&D.
Number is
All staffs, right?
Sorry,
Number is
180. Number is not
it's greater than one. Oh, sorry, it's 180. I was seeing API DMF greater than 135. Sorry. Yeah, 180.
Yeah, the number is 180, and this 180 number includes everything.
And this R&D facility is at all the plants, or it is located at one place only? I can see the API facilities at two places and formulation facility at one place.
We have two R&D center, one for the API, which is located in API unit, and another is on the formulation, which is located at Vajra.
Okay, thank you.
Thank you. The next question is from the line of Aniket Pania from Baroda BNP Paribas. Please go ahead.
Yeah, hi. Thank you for the opportunity. So I have 2-3 questions. So first of all, on the API side, what is the length of the contract that you have with the clients, like for 6 months or yearly basis? How is it, and does that include the price escalation clause with the clients?
So typically, we don't have any contracts with the clients. And, the reason for that is that once you start working with a formulation company, there is a lot of stickiness between the two. So, like for many of our customers, we are primary source. And in case for some we are secondary, the intent for them has been to make us as a primary source. So, when you have that kind of a stickiness, you don't have contracts. We have quality contracts in place because that's somewhat like a requirement for the authorities. But when it comes to supply contracts, I would say very few companies would have, like larger MNC companies may have supply contracts, but many of the other ones would simply be working in terms of interacting with us and kind of working in terms of what their requirements are.
So you and so if there's an increase in prices, is it like do you all are able to pass it on?
Sorry?
If there's an increase in prices from your end, do you pass it on to the clients?
No, so we've neither increased our prices nor decreased our prices. In one of the earlier discussions, I mentioned that in case there is a pricing pressure on us, we kind of compensate it through our R&D, and in case we are able to save, then that is something that we keep to us. So we've neither increased or decreased prices to our customers, most of our customers, I would say, in the last years.
Fair enough. So secondly, on the formulation side, how many launches are we expecting, this including India and our rest of the geographies also? How many launches, and if you are giving any guidance for growth for the next 1-2 years?
So, on the growth guidance, we did speak about a while back, so, I won't repeat on that. But on the launches, yes, we have filed for a couple of our products. We are expecting approvals in different markets, and these are new product launches. And also in India market, we have launched the rheumatology segment, and this is an extension to the autoimmune that is there. So within the intra, if you see, which is our nephrology dialysis business, we have a rheumatology business also, which has been launched, and we are seeing good traction even in that segment. So, where we see good opportunities in terms of products, we would be looking at launching. Some of them we are doing it in-house, whereas some other products we're also in licensing those products.
Fair enough. And so just lastly, on the CDMO front, what is the mix that you are looking at in the long term, beyond 3-4 years? Like, what kind of contribution should one expect from the CDMO business?
See, CDMO, if you see, is a very big opportunity, and it is very sizable. But I think conservatively, if I would have to look, I would say that what internally what we are seeing or targeting is that if we are able to get maybe 4 or 5 opportunities, maybe in totality around $40 to $50 million. That itself is a sizable opportunity given where we are now. This number instead of 50 million could be 15-20 million also. Because as I said that there are not many fermentation players who have the kind of strengths that Concord has, because with our capacities, regulatory approvals, expertise, given the cost advantage that we have versus Europe, and given what is happening with China, people trying to de-risk and looking at India, we have everything in place to kind of become an ideal partner for many of these companies. So the numbers could be very large also, but if I consider maybe 4 or 5 opportunities with a total 40-50 million in total, that itself gives us around 6 to 7% annualized growth over what our historical growth has been. That is something that internally we kind of look at, that how we can kind of build at least a $40-50 million opportunity on the CDMO, while it could be larger as well.
No, fair enough. That's it for myself. Thank you.
Thank you.
Thank you. The next question is from the line of Maitri State from Choice Institutional Equities. Please go on.
Hi, thank you again for the opportunity. Just a couple of questions. Are we still on track to achieve a 25% CAGR on our consolidated top line revenue? And earlier, I believe we had said that we are expecting a 35 to 40% CAGR on formulation. So any comments on that?
So again, when we say a 25% CAGR growth, let me maybe make it a little bit more clearer that Concord has all the ingredients in place to kind of go towards that kind of growth. So, when we talk about the capacities are there in place, these capacities in their current form can give sales much over the 25%. Do we have a differentiated strategy in place? So as I said earlier, in fermentation, there are not many players, and Concord has been gaining market share on its existing products as well as on the new launches that we are doing. So our current business continues to do well. Historically, you have seen that we've had close to around 18% CAGR growth for many, many years now. But that being said, there could be a little bit of variability depending upon how the things move. On top of that, we just spoke about the CDMO business and the injectable business. So if I say a $40-50 million opportunity on CDMO, that is close to around 400 crores, which if you take it on a 5-year, 6-year period, this could be around 6 to 7% growth. If you take the injectables, this facility can do close to 600 crores. Even if I take a 300 crore, conservatively on a 5-year period, because the first 1 or 2 years is going to be more about the submissions to the authorities and then so maybe from 2nd, 3rd, 4th year onwards, it will start contributing. So if I take a 300 crore opportunity also, that itself translates to 5%. So on our baseline growth of 18 plus 5 and plus 5 kind of gives us, somewhat of a clarity that yes, 25% can be done. So I would also not know how my 5 years look like, but what gives us the comfort is that we have all the right ingredients in place to kind of achieve those growth, and something that we have demonstrated historically. That's how, the number comes out. And when we talk about the formulation, if we have to grow at this kind of a growth that we speak about, with an 80-20% way that we are looking at, those numbers automatically translate to 40% growth if you're looking at from a formulation which has a relatively lower base.
Okay, understood. That's all. Thank you.
Thank you.
Thank you. As that was the last question for the day, I would now hand the conference over to the management for the closing comments. Over to you, sir.
So thank you everyone for joining on our Q1 FY26 earnings call. We hope we have been able to address all your queries. For any further information, please get in touch with us or SGA, our investor relation advisors. Thank you once again and have a good evening.
Thank you. On behalf of Centrum Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.